Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. In this presentation, I want to talk about different investment accounts and taxes. So I can kind of tell you what I do. I am not a tax specialist. This is just a viewpoint from me. So do not take this as tax advice. This is just my opinion and what I am doing and how I view some of these accounts. You can also get more opinions than just mine on this. Because I'm not an expert on it. I want to make sure that's clear. But I'm going to talk about it so you guys get a little bit more knowledge about it or experience and exposure to it. Because I figured this out by myself, but maybe you guys want to hear it from me. So this is different investment accounts and taxes, and where I put a lot of my money. So this is the short-term and long-term capital gains tax rates by incomes for singles, and this is the only thing that changes if you're married is this income amount. The short-term capital gains tax is the taxes here for short-term and long-terms on the right. And a lot of people fall within, I would say, this range in here. So you're going to be getting taxed 12% or 22%. And this is kind of funny. I didn't even really realize this. You get 12% tax rate on the short-term capital gains. You get 15 on the long. Do you try to sell for the short if you're below 38,000? Oh, okay. That's a very small amount of money. Okay. So this is what it is. I try to get mine over here in a taxable account, but it's not going to prevent me from selling. So I'll just wanted to go over some numbers here real quick. If you take a 24% or 22%, I think I used the 22% because these are real close. Let's do some playing with a short-term capital gains tax here. So short-term capital gains tax, let's say you're being taxed at 22%. In order for the sale to work to buy more shares of what you are selling, let's just do some math here. You've got $1,000 of shares. They trade up to $2,000 in profit. You need to pay taxes on the $1,000 of profit. So that's 22% times 1,000 is $220 of tax. So really what you do is if you sell, you're going to have to make up $220 of tax. So the stock, whatever next stock, if you're going to buy back in the stock that you own, you have to make more than, the stock's going to have to pull back and give you a greater return of $220. So another thing, if you're trying to trade in and out, you're going to pay these taxes on a short-term tax basis. You're going to have to buy it at a better entry point than what it is at today, because now you have to pay the $220 of tax. So it's got to go down for you to make, to break even. The stock has to go down to break even. You're going to subject yourself to getting caught out of the stock as well if you time things incorrectly. So there's a big risk there, and it has to go down in order for you to be even, because you're going to pay the $220 of tax at some point. And long-term capital gains tax, it's 15% for most people for long-term capital gains. A little more favorable for holding companies longer term. This next bull market, in my opinion, will definitely be over a year long in duration. And I'm definitely holding for over the 1 year time frame. So that's my outlook for this. And trading losses, if you don't have capital gains to offset the capital loss, you can use a capital loss as an offset to ordinary income up to $3,000 per year. Now, if you have more losses than $3,000 per year, so if it exceeds that, your net capital losses in excess of $3,000 can be carried forward indefinitely until the amount is exhausted. So if you have large losses, you can claim up to $3,000 per year and carry it forward for as much as you have. So if you have $15,000 in losses and you don't have any other losses or capital gains, you can use $3,000 per year for many years. Here is the individual account. This account is a taxable account, but you can take money out at any time. So you can move money around, you can take it out, you can do whatever you want with it without any penalties or any problems. That's what the advantages of an individual account. The downside is it's a taxable account. This is subject to the tax amounts of short-term and long-term capital gains taxes. This account can invest in anything. So you can basically do ETFs, mutual funds, and individual stocks. Whatever's out there, you can invest in it. Now, in a Roth IRA, you put a lot of money into. I put a lot of money into Roth IRAs for myself and my wife. Right now, the amount you can put in per person is $6,000 per person, or $12,000 in total for each year. You can withdraw money tax-free so long that you've had the account for longer than 5 years and are older than 59 and a half years old. You can also take out money that you put in, your base money, not your profits. You can take out your base money after a certain time period. I can't remember what that is. I think it's 3 years. If you want to buy a house, if you want to do some of that stuff, you can take out this. So let's say you put in $6,000, you wait 3 years, you can take out that $6,000 penalty free if you want to use it to buy a house or something. Traditional versus a Roth 401k. Really, the difference here is where you pay the tax. The Roth IRA, you pay the tax up front, and then you grow the money tax-free, and you can take it out tax-free. The traditional is you take pre-tax money, so the money goes in pre-tax, and at the end, you pay the taxes when you take it out, and you're going to pay taxes on all the gains. So I have a 401k, and I'm putting my money into a Roth 401k at this moment. I have a lot of kids that I support right now, and I get more tax write-offs and credits for 3 kids and my wife who doesn't work. So I'm doing it that way. If you calculate it, I don't really pay much in taxes. I'm paying the taxes right now and letting the money earn tax-free to take it out later. When I was younger, I put it in pre-tax because I didn't have any write-offs. I didn't have anything to really bring my taxable money down. So I put a lot of it in my 401k pre-tax when I was young. Again, this highly depends on how much money you expect to retire with and if paying the taxes now is better. Because you may retire, you're taking out a far less income and you're going to pay lower taxes in the future if you're only taking out $38,000 or $40,000 and everything's paid for already. So you might pay lower taxes in the future in comparison to now. And if you expect low income when you retire, it may be better to do it with a traditional 401k and pay the taxes later. So 401k withdrawals, the IRS allows penalty-free withdrawals from retirement accounts after age 59 and a half and requires withdrawals after age 72. So you have to take it out after age 72. Some of these accounts are owned by your employer. And if you want money out of the account, you will need to roll it over to another account. And you can do that while you're employed, but most of the time people do it after they're separated from the company. Some 401ks have limited investment options, and it would be good to roll over the amount to another rollover IRA account where there's more options. And if you're into this stuff, again, I would roll it over and buy individual companies or ETFs. And my account with the company right now does not allow me to buy individual stocks or ETFs or anything. So my strategy is I put my excess income into Roth IRAs. I also put a little into an individual account to build that up as an emergency pile to hit if needed. I also put income into physical precious metals outside of all these accounts. It diversifies it, and I'm off the grid. I also put the minimum into my 401k for the best match my company offers, and only do so as the investment options in this account are much more limited. So that's what I do. I've got all these accounts too. I really try to limit how much money I put in my individual account. I build it up to a certain amount. I want, for me, if I have a couple $100,000 that I can have access to very easily, that's what I grow it to. The rest kind of goes to physical precious metals because that's off the grid, so to speak. And then my taxable type of amount, if you're going to move in and out, if you have to do something, is in that just individual account. It's another bank to hit. Now, all the other money, that's all in either physical precious metals or it's in tax protected accounts, Roth 401k, Roth IRA, and those types. I do have a good chunk of pre-tax money in my 401k as well. So I'm taking a diversified approach of pre-tax and Roth 401k in my 401k. So it's a little bit of both. When I was younger and making good money, I wanted to reduce my taxable income because I was single. I did it pre-tax. Then we had kids. She stopped working, my wife. And then what happens is you have all these credits and write-offs. And it's like, well, I'd be better off just doing a Roth 401k and pay a little bit of tax than paying a whole bunch. So I pay a little bit up front, dump it in there, and make a bunch. Hopefully that's the case. So if you guys like this content, give me a thumbs up. If you guys have any questions or concerns, put it in the comment section. Love to hear your opinion or questions. And thank you for listening. This is Finding Value.